Good afternoon or evening, whichever it is for you. Welcome back to Hugh's Market Minute, where we can share some of our thoughts, update you on some of our thoughts on what's going on in the financial markets. Obviously, as we've said before, this has been a very long bull market, a very long economic recovery compared to all the others during the post-war period. We're now at starting 93rd month of the bull market, and the average in the post-war period, 57 months. But it's worth keeping in mind that it's still the case that there were three other bull markets that were longer, so there's no reason this one can't go any longer. It will. It looks to us as though it will go longer. What we pay a lot of attention to is the performance of the financial markets, whether investors collectively are telling us that we're at or near the end of the cycle. We pay a lot of attention to also the important monetary and economic variables, especially things like the index of leading economic indicators, to see if they're turning down and tell us the economy might run out of steam and we'll be headed towards a bear market that's accompanied by a recession. Right now, as we look at things, we don't see that. So even though this is a very long bull market and a long recovery, it looks to us as though there's further to go in the current recovery. I wouldn't be at all surprised to see a little speculation in the markets. In other words, for the markets to become a little bit frothy, for optimism to become a little bit more widespread. It's not widespread at all. There's very little optimism out there. But if optimism were to become widespread in a somewhat more speculative market environment, I wouldn't be surprised to see that in the weeks and the months ahead. This is, of course, an election year, and it's very important to recognize or remember a couple things. First of all, election years tend to be pretty good for the markets because, of course, there are a lot of promises that are made by politicians that are probably going to be broken, but nevertheless promises that are made during the election year, and that tends to lift spirits. I think the message of the markets, we've had a little bit of a gentle decline in the markets since September. I think they're really reflecting the fact that, generally speaking, investors collectively, again, expect that Hillary Clinton is going to win the presidency. It looks like a Democratic presidency, which means probably continuity and stability, not much change in public policy. But it's also starting to look as though the Republicans are going to retain control of the House of Representatives, which means that some of the very significant tax increases that Secretary Clinton is advocating, some of the tax increases, particularly on the wealthy, capital gains taxes, estate taxes, they're probably going to be, I don't want to use the expression dead on arrival, but they'll have difficulty getting any of those tax increases through the Congress. So that's why we've got a little bit of a negative, but not much of a negative or a big response in the financial markets. I think you'd see a much bigger response in the financial markets, and it most likely would be negative if it started to look as though candidate Trump were to win, or, very importantly, if the House of Representatives were going to shift to the control of the Democrats. Right now, it doesn't appear that way. So that's something we're watching really very carefully. Another thing, of course, is we're watching just generally the fundamentals that drive stocks. Federal Reserve, we still expect the Federal Reserve to raise interest rates in December. When interest rates are rising, that tends to be a little bit of a drag on stock prices. It doesn't kill off the stock market until you get to a much higher level, but nevertheless serves as a little bit of a drag. And of course, the other thing that we have to watch very carefully is earnings. Earnings are coming in the third quarter of 2016, a little bit better than expected. It looks as though for the first time on a year-over-year basis, S&P 500 operating earnings might be on a year-over-year basis again positive. We'd expected something like a minus 2% year-over-year growth rate. Now it looks like it's going to be positive 1 or 2%. This is still not the kind of stuff that really makes for a really good bull market. That's why I think we need a little bit of speculation to move higher. Valuation is a deep concern. It's hard to make the case for higher stock prices when you've got interest rates rising just a little and that the growth rate of earnings, even though it's positive, is not very positive. In other words, is very low single digits. So we're watching it all. We're not making big changes in portfolios. The number one change that we're going to make, the most important change that we will make in the future, of course, is to when we see those signs that a bear market is coming that will be accompanied by a recession, we're going to need to reduce your allocation to equities, increase your allocation to fixed income in order to try to preserve capital and give you good returns, or at least decent returns, in a bear market. So that's going to be our real test. There's no guarantees, as you know. We have some disciplines that we follow. They've worked pretty well in the past, but who knows if they'll work in the future. But that's the number one thing we're looking out for right now. So for now, we're making no changes, big changes, significant changes, asset allocation changes in portfolios. But you can bet we're watching really carefully. I really appreciate all of the confidence you continue to show in us. We're working really hard on a daily basis. As you know, we've added a real good professional, Andrew Halliday, to our staff. Andrew's a lawyer, does a lot on estate planning, financial planning, a real capable person. So it's great to have Andrew on board as we continue to expand in a successful business. We appreciate your support, because it's your support that really makes the success that we've had very possible. If you have questions, call myself, call Dan Nolan, call any of the members of the staff. Diane, we're all here. We love hearing from you, and we love talking about all the kinds of questions and concerns you might have. Again, thanks very much, and look forward to the next time we can get together.